Good morning, Togglers. Welcome to today's edition of Toggle's Daily Video Insights. Today, we're going to take a look at why there could be potentially as much as 16% upside to Verizon, and this on the back of relatively inexpensive valuation that goes back to the times of the global financial crisis. As you can see here, actually, Toggle has highlighted a number of positive insights for Verizon, so it really does look like it's potentially poised for a move up, but it's stubbornly stuck in this range. So let's take a look at the latest insight and see what that adds to the overall picture. Clicking on the insight itself, you can see very quickly that there have been 11 similar occasions where the price to book for Verizon reached a similar level, and that the typical response, of course, within quite a considerable range, was a 16% move up over the following 3 months, which starting at these recent prices would take Verizon stock up to about 65.01. And note again that although it is a 3-month horizon, the range of outcomes suggests that in quite a number of cases, this level was reached substantially sooner. In fact, it looks like within a few weeks to a month rather than all the way to 3 months. It also had in the past exceeded the level to reach 70 plus on the stock price. Let's take a look to see what exactly is going on. So the price to book ratio here, the last times we've observed comparable prices goes all the way to 2008, 2009 period, and prior to that to kind of the early 2000s. So this really is quite an interesting situation that should put this stock on your radar screen. And to the extent that your technical picture or the fundamental assessment of the company agrees, it might be an interesting time to look at this stock, whether or not it fits into your portfolio. Looking at the past performance, again, you can see that actually there is quite a large concentration of these green dots. These are the returns in the aftermath of those past episodes where the stock had comparable valuation, and quite a number of returns subsequently were in excess of the 16% typical return. At the same time, of course, there were quite a number of them that were substantially below it. But the more important takeaway is that it does seem like there was a bit of an upside skew if you had bought the stock at these levels of valuation, of course, needing some kind of a positive catalyst to move it away from it. Importantly, as always, is that when you track the price, that it does not fall below the red line here at 51.47, because presumably falling outside of the confidence interval suggests that the driver may be something other than valuation, and potentially there's another reason why the stock continues on its trajectory down. So it's a good level to reassess whether or not you want to continue to stick with the thesis and if the stock really does fit with your overall picture for both the market and the company itself. So much for Verizon in the daily brief. Today, we also discuss a couple of issues related to risks upcoming for the market as we end the summer, in particular the debt ceiling. So if you subscribe to it, the daily brief should already be in your mailboxes. If you don't, you can go to toggle.global and sign up for what is aiming to be your daily dose of market relevant content, whose sole purpose is to hopefully spark one or two trade ideas for you to take a look at. Otherwise, like this video or subscribe to our YouTube channel if you'd like to see more of them. We do this every single market trading day with a single-minded goal of breaking down the barriers between the vast ocean of data out there and you, the individual investor, helping you map these changes into the impact and forces that might be driving assets you care about. Thanks for your attention, and we'll see you again tomorrow.